China's economy is in deep trouble, and the world is watching as the second-largest economy faces a crisis that could reshape the global landscape. From collapsing real estate giants to weakening exports and mounting debt, China's economic model is being put to the ultimate test. Will these ambitious initiatives be enough to pull China back from the brink, or are we on the verge of a global economic reset? Let's break it down here on Politalysis.
Now, China was expected to experience a rip-roaring recovery after it lifted strict COVID-19 restrictions, but almost a year after the measures ended, the Chinese economy seems to be stumbling.
He believes restructuring China's local government debt remains crucial for the country's economic revival.
The Chinese economy, once celebrated for its rapid growth, now finds itself teetering on the edge of a major slowdown. At the center of this crisis lies an overdependence on the real estate sector, which adds about 29% to China's total GDP. This is much higher compared to the 15 to 20% seen in other big economies. For years, developers like Evergrande were the face of China's explosive growth, building new cities and homes at an unprecedented pace. But now, the boom has turned into a bust. Evergrande alone carries more than $300 billion in liabilities, and construction has stalled. Ghost cities, empty monuments to an unsustainable model, dot the Chinese landscape, reflecting the downturn in consumer confidence and a steep decline in property prices. Uninhabited developments, or ghost cities, have proliferated, with an estimated 65 million empty apartments scattered across the country. These vacant structures reflect the collapse of consumer confidence, and property prices have dropped nearly 20% since 2021, illustrating the fragility of an economic model once hailed as unstoppable. The collapse of real estate prices has shaken consumer confidence, with property values falling by nearly 20% since 2021. When the real estate sector struggles, where around 70% of household wealth is locked into property, families feel a sharp drop in their wealth, causing consumer spending to plummet. This situation is even more dire because many local governments rely on land sales to developers for up to 40% of their revenue. As property values drop, financial pressure spreads across China's provinces, with an estimated 57% of local government debt now linked to real estate-related revenue. With homeowners unable to sell their properties and millions of unfinished apartments remaining unsold, consumer spending has plummeted. Beyond real estate, China's export sector is also facing serious challenges. For decades, China was the world's factory, producing everything from electronics to textiles for global markets. Factories are cutting back on production, leading to a rise in unemployment, particularly among the youth. The numbers paint a grim picture. Youth unemployment soared to 20% earlier this year, and third quarter GDP growth was a mere 4.6%, falling short of the government's 5% target and marking one of the lowest growth rates since the early 1990s. This is the lowest growth rate in nearly 2 decades. Beijing is scrambling to contain the fallout, introducing stimulus measures like interest rate cuts and bailouts for local governments, including cutting benchmark interest rates to 3.5% and allocating over $200 billion in bailouts to aid local governments. But will it be enough? China's policymakers have promised a combination punch to stabilize the economy, including expanded financial support for homeowners, a $100 billion fund to recapitalize struggling banks, but the question remains, can they turn things around? Xi Jinping's government faces an incredibly delicate balancing act. On one hand, there's a pressing need to provide stimulus and boost the economy. On the other hand, there's the issue of mounting debt. China's total debt, including corporate, local government, and household debt, has reached approximately 280% of GDP, with local government debt alone accounting for 57% of GDP, raising fears of a Japan-style lost decade or worse, a full-blown economic crisis. The government's reluctance to fall back on debt-fueled growth, as it has in the past, reflects a shift in thinking. Xi is focusing on new productive forces, such as green energy and technology, shifting away from the traditional debt-heavy approach. high-tech manufacturing grew by 6% in 2004, surpassing older industries, while renewable energy efforts have made China a global leader, now producing 80% of the world's solar panels. The stakes are high. Failure to stabilize the economy could undermine Xi's long-term strategic goals of doubling per capita GDP by 2035 and positioning China as the world's largest economy. More than that, it could spark social unrest among a population that's grown used to rising living standards. What does all this mean for the world? The impact of a slowing Chinese economy extends far beyond its borders. For years, Xi has emphasized new productive forces, like green energy and technology, moving away from the traditional debt-heavy approach. In 2024, high-tech manufacturing grew by 6%, outpacing older industries. Meanwhile, China's focus on renewable energy has established it as a global leader, now producing 80% of the world's solar panels. China imports over $1.4 trillion in goods each year, including essential resources like 70% of the world's iron ore exports, which fuel key sectors like construction and manufacturing. Its demand for raw materials, machinery, and consumer goods drives economies worldwide. A prolonged slowdown in China could reduce global growth by as much as 0.4% annually, especially affecting regions like Europe and the US, which are already dealing with inflation and slower post-pandemic recoveries. Supply chains, too, are likely to be disrupted as companies look to diversify away from China, adding more pressure on global trade. In the financial markets, the uncertainty surrounding China has already made an impact. Investors are wary, and foreign capital is flowing out of China at a rapid pace. In the third quarter of this year, China posted a foreign investment deficit for the first time since records began, with over $11 billion leaving the country. The fear is that if Beijing cannot restore confidence, this trend will only accelerate, leaving China more isolated from global capital markets. With the world watching, China's next steps could determine not only its own future, but the future of the global economy. Will Beijing manage to stabilize the ship, or are we witnessing the beginning of a prolonged economic decline? The answer will shape the next decade of global growth, trade, and geopolitics. To understand the roots of China's current economic woes, it's essential to revisit the country's economic transformation over the past several decades. China's current economic challenges trace back to the sweeping reforms launched by Deng Xiaoping in the late 1970s. These reforms marked the beginning of China's industrialization and modernization, opening the country to foreign investment and allowing market forces a larger role in the economy. Special economic zones, SEZs, in cities like Shenzhen and Xiamen attracted foreign companies with incentives to set up manufacturing. From 1980 to 2010, these reforms helped lift over 700 million people out of poverty, transforming China into the world's second largest economy, with GDP reaching over $17 trillion by 2020. This period of growth lifted hundreds of millions of people out of poverty and transformed China into the world's second largest economy. However, the growth model that powered China's rise has now become its Achilles heel. The growth was largely driven by investment in infrastructure, manufacturing, and most notably, real estate. In the 2000s, as China continued to urbanize, real estate became a major driver of economic activity. For years, this model appeared highly successful, driving annual GDP growth rates of 9 to 10%. The government supported this rapid growth as a way to boost the economy and create jobs for millions of migrant workers. Local governments also got in on the action, borrowing heavily to fund infrastructure projects and selling land to developers to keep the boom going. For a time, it seemed like a win-win. But as the years went by, the risks associated with this model began to accumulate. Another critical factor contributing to China's current economic troubles is the demographic challenge. China's population is aging rapidly, and the workforce is shrinking. The one-child policy, which was in place for decades, has left the country with a demographic imbalance that's now putting immense pressure on the economy. Fewer young people mean fewer workers and consumers, which in turn means slower economic growth. The government has tried to encourage families to have more children by relaxing birth restrictions, but these efforts have so far had limited success. The demographic squeeze is exacerbating the challenges faced by the economy, particularly in terms of labor supply and domestic consumption. Trade tensions with the United States have further complicated China's economic landscape. Over the past few years, the U.S. has imposed tariffs on Chinese goods and restricted access to key technologies, particularly in the semiconductor industry. These measures have not only hurt China's export sector, but also highlighted the country's dependence on foreign technology. In response, Beijing has doubled down on efforts to achieve technological self-sufficiency, pouring billions into domestic semiconductor production. Despite these investments, China still lags behind global leaders, and catching up will require time and significant resources. In addition to these structural issues, the Chinese economy is grappling with the fallout of the COVID-19 pandemic. The pandemic disrupted supply chains, slowed global trade, and led to widespread lockdowns that hurt economic activity. While China initially managed to keep the virus under control and restart its economy, the longer-term effects of the pandemic are still being felt. Consumer confidence has been slow to recover, and many businesses have struggled to survive. The combination of these factors, real estate woes, export challenges, demographic pressures, trade tensions, and the aftermath of the pandemic had created a perfect storm for the Chinese economy. The government's response has been to introduce a series of stimulus measures aimed at stabilizing key sectors and restoring confidence. Interest rate cuts, support for local governments, and targeted bailouts have all been part of Beijing's strategy. However, the effectiveness of these measures remains in question. Critics argue that without addressing the underlying structural issues, such as the over-reliance on debt and the need for greater domestic consumption, these measures are merely short-term fixes. Could China's economic model truly withstand the pressures of global demand and internal reform, or is a full transformation inevitable? If you found this analysis insightful, please like and subscribe for more.